John Akridge is joining us, the CEO of Hyatt Capital Markets. John, good to have you back on the program. So let's start off with the DB situation. What does it mean to you? What are clients sort of thinking about in terms of how this applies to anything here, financial banks here? What's the implication?
Sure. The European financials have really been behind the curve a bit compared to U.S. financial banks post the financial crisis. So I think this has been a long time coming. I think this should be viewed positively by the market, certainly by the financial community. A little surprised that Deutsche Bank isn't trading up a little bit on this. Maybe there was some anticipation. I know the stock's been trading a little bit better, albeit from pretty historic lows for the last couple of weeks. But yes, this should be viewed positively by the financial system. It's, again, a long time coming. Pretty remarkable, thinking what Deutsche Bank's done back when they bought Bankers Trust and Deutsche Bank, et cetera. Pretty interesting, right? Alex Brown way back in the day.
Yeah. Obviously, the story here has been going on for years. Obviously, I think many can sympathize with the idea. It's not a shock that there's a restructuring coming, but the size, the severity, and then I think particularly the closing of the equity desk has got some kind of thinking about ramifications for really how banks make money. At the same time, you've got a market that has been looking at financial sector lagging for like a year and a half. Everybody says, outperformance is coming, outperformance is coming. I mean, is this a sign that they're going to have to find new ways to make money, even if they're not in trouble like DB, about growth, really?
Yeah, it is for sure, Oliver. I think the real issue here is you look at a lot of these very large financial institutions, and really where they make their money is based on spread-based lending. That's really what these institutions have become, and you're seeing, the equity side in particular really has come under a lot of pressure over the last decade, if you will, and you're seeing more and more people, pare back / exit. We're being, ETFs have obviously really eaten into this equity market as well. So I think you'll see more and more of this as large financial institutions continue to pare back their equity exposure and look more towards spread-based lending. That's really what these institutions are.
Of course, John, whenever you have a bank under duress like this, there's going to be questions about where the knock-on effect is, what they own, where their debt is exposed to, all that. Any idea about the systemic potential here? Or is this something that we can take in stride?
Good question. I wouldn't say that there's a systemic issue here. I do think what you could make the analogy to, though, is that the European financial institutions really have been a little bit behind the curve writ large. And so seeing Deutsche Bank do this, there probably are some more moves that some of the other large financial institutions over in Europe could do. But if you look here in the U.S., our financial institutions are in a much stronger position. They really took a lot of the pain back during our crisis and really look a lot stronger coming out. So I would actually say look at it more as a positive for the U.S.-based financial institutions, maybe gaining a little bit of market share, albeit a bit of a challenged equity environment.
John, to kind of pivot here, this morning I see headlines about what's going on with Draghi and the ECB and just general European central banks signaling there's more money on the way for markets through, QE, pseudo QE, whatever you want to call it. But clearly there's issues that are European that don't really apply to us. Are investors at risk of taking what they see from the European central bank process right now and just porting it over to what Powell's going to do over the next 6 months? Do we have to be careful about saying because Draghi does this, Powell's going to do, the same thing, basically?
For sure. I think that's really, even I would say, Oliver, that a lot of this criticism that the Fed has faced for maybe being a bit, if you will, behind the curve, it's really just because the rest of the central banks around the globe, in particular ECB, has moved more quickly. If you look at our economy, we're chugging along. I know it's not really exciting, but we're still chugging along here. And so Jay has taken a lot of criticism for being a bit behind the curve, but it's not really because of what's happening here in the U.S. Yes, we're seeing a little bit of a slowdown, but nothing too dramatic. It's really because of what the ECB has done. And so I do agree that all eyes are on the Fed right now this week as we get a week ahead of earnings that'll kick off next week. And it does look like the Fed is going to cut by 25 basis points and probably another 25 is priced in. let's see how things go. I think the Fed's doing a pretty good job, all things considered. If you can, kind of look past the administration's noise or criticism of them as of late.
John, the statement from Powell this week is going to be in front of Congress, so it might have a little bit of a different feel to it. But obviously, market participants are going to be reading through everything. It comes right before CPI. Is there any potential for a big CPI? Not that we've seen any big inflation numbers in recent memory, basically. But even if we do get that, to a sizable beat, does that do anything to July, or in your mind, is it done deal for Fed?
I think July is a done deal for 25 basis points. I think that's what's going to happen. You are pointing to the right number to be focused on. Certainly, if we look back in the rearview mirror for the last, the jobs report, for instance, on Friday, was a very good print, and people were worried from the print prior was a very bad print. So yes, I think CPI, it really is remarkable, Oliver, that we really haven't seen any inflation. Almost everybody, including myself, would have expected to see a little bit more inflationary pressures in this economy, and it really hasn't materialized. So yes, I think that is the number to look for to maybe see a change to where we are. But I think 25 basis points is pretty much baked in the cake. The market's expecting that. I think a deviation from that would be a surprise at this point.
We saw on Friday, John, the non-farm payroll headline beat. Even if it didn't change the July chances for a single cut, which it didn't, it did change the chances for the double cut, which basically disappeared from about a 22% lingering probability, according to Fed Funds Futures. Then you had a response in gold that was pretty dramatic. That seems to be tied to central bank action. Stocks sold off pretty hard, but then did have a nice recovery. Still ended down, though. Or did we get a little taste of what happens if the Fed doesn't perfectly match the market's estimates? Is this the risk point for equities?
It probably is. I do think that the Fed has changed. Anytime that the Fed is in the process of shifting gears, if you will, it's always a little bumpy. And certainly if you look at somebody who's newer in the role, if you will, from Chairman Powell, look, they're changing gears. 25 basis points is probably baked in. The Fed is probably more on a path of easing versus tightening, or even sitting still as we have been for the last 6 months or so. I think the market is a great place to be, and I think you should be positioned for a reflation trade, if you will, as far as assets are concerned. And, seeing the dollar come in a little bit, equities go higher, see gold go higher. I also think you're seeing another reason why you're seeing some of these cryptocurrencies, as you talked to your prior guest, Bitcoin, et cetera, catching a little bit as well, adding a little flame to that, fire as well, a little fuel to that fire as well.
Reflation trade, I know you gave us a little taste there, but some more details, John. Can you give me an idea where you see the most opportunity if that trend takes hold?
Sure, equities. I think you got to stay with equities. Obviously, earnings are getting ready to kick off here next week, and we might see a little bumpiness, if you will, or a little weakness. But, going into earnings, it always seems like Wall Street gets a little nervous, and all of the prognosticators, including myself, come out and say, look out for maybe a little weakness here on some of these numbers. Maybe Wall Street's estimates have gotten a little ahead of themselves. I think the earnings picture is going to be pretty solid, and I think equities is the place to be. I know we're at all-time highs pretty much, and so we need to be a little bit careful. But I do think buying on a little weakness is the way to be positioned here as we go into the better part of July and maybe into the doldrums of August. I think the Fed is going to be on the side of investors' friends, if you will, and I think equities are the place to be, and let this market continue to grind a little higher.
John, the sort of sector outlook right now, and where do you think about it in terms of as something as simple as that, which is, look, if the Fed right now is going to do something that's stimulative to the economy, is it the same blueprint as what it has been in the past? Because we've had some different leadership over here in this market for the past year and a half. I mean, I know year to date, you've got tech, you've got growth names, but you take a little longer horizon since we first got to the 29 area on the S&Ps, and there's been some leadership shifts, right? High beta stuff has not been quite as powerful. It's been like this utility trade and more.
More defensive stuff. You're right. Look, I think financials is a really great place to be right now. Certainly, if the Fed's going to, start cutting short-term rates, that is the cost equation to the fund for them for funding. That should help expand margins. I know that the long end and the 10 years come down too, so their ability to lend at higher rates has been under a little bit of pressure. But yes, I think the financials is a great place to be. I think the financials will do well really through the rest of the year. Some of the big banks, even some of the regionals or Regions Financial, Zions, those are two great financial institutions that really aren't affected by global issues, more U.S. centric, large regionals. I think they're a great place to be, and I think they'll do very well going into the end of the year here.
John, before we let you go, just real quickly, last point, because I'm looking at this morning, you're getting just this bid into European yields. Obviously, there was a positive development in Greece kind of to offset what was going on in Turkey, but now you've got yields there that are basically with the U.S. 10-year. I mean, it's wild. Is there no consequence to just never-ending negative yields around the world?
Great question, Oliver, and I think we've all been scratching our heads, looking at this for the last, ever since really the Great Recession, and it certainly doesn't seem like we've seen a huge negative effect on it. I certainly believe long term, we certainly could go down the path of, Japan, and that wouldn't be very positive. But at the moment, it seems like everybody's doing the same thing, and so as long as we are, the prettiest girl at the dance, if you will, things seem to be fine. And so I do think it's remarkable, though, to see some of the yields and where they are in Europe versus the U.S. We probably very easily could be 50 to 100 basis points cheaper. And that's also where I think, the Fed is looking, and that we are in a global system here, and we can't just operate on our own island, if you will. And we need to look at what the rest of the world is doing. And that's why we're probably cutting rates even in an environment where we probably don't really need to. Forget about what the administration is clamoring for. All administrations want easier money because they're trying to get reelected. So, I think we are going to see a little lower rates on the short end. And that's probably going to fuel, again, stocks in particular to go higher.
Yeah. All right, John, really good stuff here this morning to help us kick off a long hit to get us ready for a busy week. John Akridge is the CEO of Hyatt Capital Markets.